Good afternoon. It's 1:23 p.m. Eastern Time, Friday, October 25th. And this is an update of the macroeconomy in terms of what our business cycle model research offers. Okay, today I found some charts on MarketWatch.com. I'm showing you one. They're put out by, some of them by the U.S. Department of Commerce. I think some have been put together by Haver Analytics. At any rate, we're looking at business investment, and we can see that business investment pulled back into September 2012, kind of floundered around as they come into year end when they were worried about the fiscal event and crisis. And then you can see that business investment rebounded somewhat this year. Now, some people are making a big deal that it's kind of leveled off, and they think it's pulling down now and makes them a little bit nervous. But the way I look at it, so what? It really doesn't show much of a change at all. It's kind of just stalled is all it's done. And of course, this title says it stalls. But I think it's held up very well with the possibility of going over the cliff here in September or October in terms of the fiscal event again, okay, and the government shutdown. So I think that this time around the business is more stable, that they were not investing for a fair portion of last year and then probably did become nervous towards year end. Now all they did was just kind of sit still as they watched the events unfold here towards the end of the year. So I view that as a positive sign, and I'm sticking with my plan. We'll probably see some improving investment next year, but it has stalled. Okay, now let's look at the global manufacturing continues to grow. Okay, we see China has rebounded here recently on manufacturing. It's a good sign. We see the U.S. tick down some, and for a good portion of this year has been drifting lower. And you can also see some kind of a pattern going from, say, the 2008 bottom to now. I think this is a 5 to 7 year cycle breaking down into 2-3 year cycles, with one with less volatility or simply not working compared to the other one. But I think it's time for a bottom. I'm sticking with our guns that it has already bottomed. This particular chart doesn't show it, but when you look at our own PMI, we actually bottomed a while ago, I think back in July. So I say 2014 will show better PMI ratings, and we should see this particular chart, which was put out by Market. I think we're going to see a nice recovery, a nice run-up for these indicators for 2014. So this is not concerning me one bit. I think it's just bottoming out if it hasn't bottomed already. Now, here's something I like. Workforce participation rate. You can see it's declining, okay? And some would say, well, that's a concern that maybe we don't have enough people coming in here to want to be employed. But on the other hand, we're tightening up the labor force, okay? And we can, let me skip this next chart. Right here's what I want to get at. Competition for jobs trending down, okay? Maybe we're losing people who are saying, I'm not even going to try for a job. But the point is the unemployment's dropping, however, anyways, okay? And maybe that's a good thing, okay? Maybe they don't need to stay in the workforce. But I think that only explains a portion of some of these statistics that are saying improving employment. I think, indeed, you have people who are saying, you know what, it's just a little easier to find that job. And what that leads to is it's just a little easier to ask for a pay raise if you're already employed, because things are tightening up a bit. It's just a little easier to say, I don't have to take this job because I need it this second because I'm scared to death I'm not going to find one in time. I can shop around a little bit. To me, that's all constructive action that can lead to a better, an improving economy, improving employment. On balance, I like these particular charts, frankly. I know somebody can twist it around and make something negative out of it, but I like what I see, that things should improve next year. Now, mortgage rates. We got a rebound, okay? We called the bottom last year correctly for rates, mainly on the 10-year Treasury note rate. And we got higher rates. Well, it was more demand for loans, but it was also a more stable banking system, a more stable economy, so that someone could actually hold out for a higher rate. In other words, the bank can hold out for a higher rate and get it. The investor can hold out for a higher rate and get it. Sign of stable, improving economy, if not just flat out more demand. Now, yes, we see a slump towards the end of the year, but you know something? Consumer sentiment normally slumps during September and October. We kind of go in a little bit of a mood. I call it the hangover from summer vacation. I think we wake up that Maybe summer didn't turn out so well business-wise. Maybe the vacation didn't turn out so well, or we spent too much. I don't know what it is, but we have a slump in the fall months. Maybe it's got something to do with sunlight hours, and we're already starting to get depressed that we have to ride out winter or something. But it's just normal to have those kind of slumps. And I don't want rates to just keep marching higher. I want rates somewhat higher, and they can bounce, then kind of turn stable, then bounce some more, have a stair-stepping thing throughout this decade. That's actually a sign of a growing economy, and it won't work against the economy, it works for it. Sure, if we just make interest rates soar, then we're actually going to hurt the economy. Okay, now let's bring up some long-term charts. You've seen this before every month. This is unemployment. And unemployment peaks every 9 years. Why does it peak every 9 years? Well, every 9 years we have a recession. Actually, it's every 8 to 13 years. It just works. It's there. And sure, it takes a few years to find it sometimes. It's a wide range for a bottom. But if you're willing to allow that, then you say, hey, this thing works just like clockwork. Okay, we have a recession basically every decade, and we're going to have high unemployment every decade, once every decade. Now, here are the bottoms. So basically, if we bottom out every decade with a recession, there's got to be some kind of peak ahead of the recession, so it must be the economy peaks out about once a decade. Well, it turns out the economy does run an 8 to 13 year cycle, bottom to bottom, top to top, and when we break that down into trends, we find we grow the economy for about 7 to 12 years, then we slow down, contract, and even have a recession for the economy, which we would call the bust trend, for about 1 to 3 years. Boom trend, 7 to 12 years. Bust trend, 1 to 3 years. So chances are the economy is going to grow to 2017 to 2019, which we've been forecasting for a very long time. Ever since we called the bottom in 2009 for the recession, we were within a month or two of it, according to the manufacturing indicators. All right. Now look at unemployment. It's trending lower, like it should be. Sure, it might not be trending down as fast as we would like, but there were some super cycles involved in this last financial crisis. It was something more important than just a normal decade. So it may take longer to get over that. It can take an entire decade in terms of depressions to get over a depression. Even though you might select 1 year as the bottom year of that depression, you can still have the entire decade as not that great. Well, that's probably the 2010s, okay? 2020s will be much better than the 2010s. But during the 2010s, we've already seen the worst. We've seen the bottom in 2009 for the economy. We've seen the peak for unemployment, and it's trending lower, and we might be surprised to see 5.5% to 4.5% unemployment by 2017 to 2019. It looks like it's trending right on track to do that, and it may even speed down and do better than that. Now, I also want to warn you, we could have the lowest unemployment ever and still not have as good economy as some years or some decades, okay? It's just the nature of things, but it will be better than today, okay? Now, we can also have unemployment that's higher than many other decades. Maybe we only get it down to 5.5%, and yet we can still have a great stock market, good commodities markets, business seems to be rolling, economy seems to be doing fairly good, people are fairly happy, okay? We don't need necessarily full employment to actually create the very best times, okay? We need to just be in the general area. So I'm happy with what's going on. I wish it would speed down a little more on the unemployment, but hey, it's working towards it. And as I've said before, if you're really serious about speeding unemployment down, you don't wait for the economy just to work on its own. You don't wait for capitalism and the invisible hand to do the trick. You take that money and you print it and you start pumping it through. Well, the Fed's printed it only to stabilize the financial system. They really haven't pumped it through in the economy, and they may not be capable of doing that. So it would take the government to do that. But the government's so fighting and arguing over everything, they're not going to do that. So we are on our own, but we are making it work, okay? The Fed has done enough, and yes, we can recover without doing any more. But what I'm saying is if you want this to speed down much faster than what it's doing now, you'd have to get the government to actually pump money out there and put people to work. Well, I think it's probably a little too late where we don't have to do that. We'll get there on our own, and we'll be just fine, and we don't need a great economy this decade. We need just a decent economy, and we're heading there, and it could turn out much better than I think even. But next decade is where the payoff comes. We'll have a really good decade. This next chart is the manufacturing PMI, Procurement Manufacturing Index. It's put out by ISM, I think it is. And it's a monthly rating. And we think we've discovered some 3-year cycles in here. See, it spanned 3 years here, it spanned 3 to 4 years here, but there's another version of this called the market that instead of 4 years, it actually spanned 3 years, bottom 2009. But it's also a PMI indicator. At any rate, granted, it can top out sometime next year, but the chances are it's going to top out for another 3-year cycle later this decade. Chances are this is going to be well supported. It's going to bounce around in this range, and as long as it spends most of its time over 50 or 50 and higher, growing economy. So we don't need great performance out of this indicator anymore. You always get the best performance coming up out of your recession. We got it. From there on, it'll just stall out in this range, but the economy itself can actually speed up or it becomes larger volume-wise. So this is bullish action. We've got a good move up for manufacturing this year, but as we noticed on that Market Watch charts I just showed you previously, according to that manufacturing indicator, it really hasn't done much. But I think it's going to catch up. I think you'll see it moving forward next year. Now this is a cumulative study of the monthly PMI, and all we do is add it if it's 50 and higher, and we subtract if it's under 50. And what that will do is take out some of the short-term noise and fluctuations and trends and whatnot, and allows us to concentrate better on that 8 to 13 year cycle I was telling you about. Okay, and we call it the 9-year cycle. So here's a recession going into 2002, 2001. Here's a recession going into 2009. And you can see the trend is up. Now this has gone to a new record high already. And what I found is there's a positive correlation to nominal GDP per capita on an annual basis. So if this has gone to a new record high, my guess is when we see the nominal GDP per capita for this year, we're going to find it's to an all-time new record high. So the economy is growing. It's bigger than ever. But it's just not growing at fast pace. It's not as exciting. But do we really need that? I'm not so sure we do. But I'm also sure, fairly confident, maybe the better times are next decade, not this decade. But notice it's marching higher. It's still moving forward. The economy is improving. Unemployment is dropping. The workforce is getting better, okay? But unfortunately, we're not really paying out the dollars to the labor force. We're actually kind of shooting ourselves in the foot by trying to keep labor costs cheap. That means less money for people to spend. So the velocity of money is not as fast as it used to be. And a lot of people are complaining about that. There's too much money sitting at the banks. The Fed printed all that money, pumped it out, but the banks hold it up, okay? That is part of the reason, but it's interesting how some Fed members don't think velocity of money has much to do with how good the economy is. I don't really agree with them on that, but I think they're going to get away with that because I think we are pulling ourselves up by our own bootstraps here, and we are building this economy, okay? And again, the only way we can really speed things up faster than what we would normally expect or get things to where we desire is we probably have to have some temporary stimulus from the government side. I'm not convinced we really need to do that, and I don't think they're going to do that because they're going to fight and argue too much about it. So at any rate, the economy is moving forward, and our forecast is to remain bullish the economy to 2017 to 2019. As of so far this month, I have not seen enough negative business statistics and information to say otherwise. Thank you.